Let's talk about that 40-year history. I mean, I'm not sure that every month or every quarter, maybe even every year you were up, but over the long term, you did very, very well. Give us some advice. In that 40 years, what did you pay attention to? What did you leave behind and not get distracted by?
Thanks for having me on the show. Yeah, if you look at over the last 40 years, what we've learned, I think kind of ties in with your first comment, trying to separate the signal from the noise. You know, what the set of ideas around which we built the firm have shown that you can have a successful investment experience without having to forecast the market turns, without trying to outguess the market. So a lot of that is tuning out the noise, focusing on what really matters. You know, you can't control markets, but you can control the amount of risk you take, for example. So that's largely what it's about, is coming up with a sensible long-term strategy and emphasizing long-term, because if you're going to invest in risky assets, you need to have a long-term investment strategy. And it's a strategy that you believe in enough that you can stick with it through the ups and downs of markets. Markets are going to go up and down. That's what they do. And so what investors need to do is figure out how to deal with that uncertainty and come up with a sensible solution for them that they can stick with.
So isn't that one of the real challenges for an investor, David? Because if you didn't have uncertainty, if you didn't have risk, you wouldn't have gain as a practical matter. The one comes with the other. The question is, how much risk, how much uncertainty? I mean, when does it leave off being an investment and turn into a gamble? Because let's be honest, some of what's going on in the market sometimes looks to me an awful lot like gambling.
Well, totally. I mean, basically trying to time short-term movements in the market is more akin to gambling than investing. And, you know, we think if you're going to invest in the market, you have to have a long-term focus. This last year, for example, has been, or the year 2020, was a great example. Market is down 30% the first few months of the year, and a lot of people bailed out. But the market ended up 20% for the year. So if you didn't stay invested, if you tried to time that market and got out, you know, you missed out on a big return.
One of the big uncertainties right now that people are talking about in the market, at least, is inflation. Whether it's, as they say, transitory, as the Fed seems to be indicating right now, or as some people like Larry Summers say, there is a danger really of it getting to be runaway. When you plan for the worst and hope for the best, as an investor, how do you do that with respect to inflation? Do you change your investment at all in planning for the worst on runaway inflation?
Well, I think you want to be sensitive to the idea that inflation could take off. Of people talking about inflation, I don't see too many of them saying, I really am confident I know where inflation's going. There are a lot of opinions floating around, and that's really the point. I mean, it's you can't forecast these things, and even if you could forecast where inflation is, you don't know what the effect's going to be on the stock and bond markets.
And as you approached this 40 years ago again, what did you really look at? Because people call you sort of a factor investor, because you tend to go, as I understand it, more value and more small cap. Was that a conscious decision you made?
Yeah. What we found was investors back in 1981 when we started, particularly institutional investors, were underinvested in small cap and really in value strategies as well. And over the long haul, small cap and value has historically had higher returns than large cap and growth. And so we have had a bias towards small and value, which, to your earlier comments, doesn't mean you win every year with those things. Until recently, there had been kind of a horrible run on value versus growth. You know, over the last 50 years, these ideas that we focus on have caused, you know, fees to come way down, risk controls to go way up. So people should have a much better investment experience than they had 50 years ago. I think that's pretty exciting. And I tell students coming out now, you can have a great career in finance, and at the end of it all, feel good about yourself, because you can help people. And going forward, I might add, if we're going to help people out, part of the answer has to be better and safer financial services.
What could we do to make them better and safer?
Well, I think a lot of it is help educating people. You know, people, you know, what you might call noise is like a siren in calling people in to do silly things. You know, all this progress, these ideas can be used for better. They can also be used for worse. I mean, with lower fees, a lot of people are attracted to come into the market that never would have gotten into the market 20 years ago. And that's terrific. Unfortunately, a lot of them have come in with the wrong set of ideas about how to invest. They think investing is gambling, and which is the wrong way to approach the market.
David, you led me to it. That sounds like GameStop and Robinhood and some of the meme stocks. What do you make of that phenomenon?
Well, you know, investing in markets can have a very high tuition in terms of education. You know, it can. The first time fortunately, people starting to invest frequently have very little money to invest, which is probably, helpful. Over time, people learn. There is no magic. That's part of the noise. People think there's magic out there. Somehow they don't have it, but somebody else has it. And if I can only figure out what that magic is, then I would really be set. It doesn't exist.